Welcome back. Okay, markets in fine terrain at this point in time. Let's shift focus to Dabur. The FMCG stocks have all been doing very well, but now in the rain shadow, how will they do from here on? Sunil Dugal, the CEO of Dabur India, joins us. Mr. Dugal, that's straight away the question. You have rural India as a big market. It will obviously be a supplier of raw material. What's the downside if it is a not so good monsoon? I mean, the last bad monsoon we had was, what, 76% of the long-term average. If things got to that point, what's the downside for Dabur?
Well, 76% shortfall is pretty serious, so I think there would be certainly some impact in terms of overall demand. Plus, there could be some inflation in agri-commodities consequent to that. So I think that's pretty much a worst-case scenario. However, if there's a small deficiency, maybe 85, 95 or 90%, I don't think demand would be materially affected. There could be some inflationary pressures building up, but the demand side should remain robust. But a serious shortfall like the one you mentioned, yes, cause of serious concern.
Oh yes, it would be serious even on other aspects like power and water, I assume. Yeah. But coming to the extent demand itself, we hear slowdown stories all over the place. They began with capital expansion and investment cycle going down. It's beginning to show in the consumer space as well. The car numbers we got for the month of June were pretty dismal, and two-wheelers, the much smaller category, also followed suit. Is it now beginning to show at your end as well?
Not yet. I don't think it's filtered down into consumer staples, especially the non-discretionary items. So I think demand will remain robust in the event of a normal or close to normal monsoon. So I mean, we're not particularly worried on that account. Of course, the monsoon being the only issue which is at stake.
We've seen some softening of raw material prices, or at least they're off their highs, Mr. Dugal. Are you expecting any gross margin improvement in this quarter? And there's also a sense among analysts that, you know, a lot of this incremental gross margin improvement could flow into advertising and promotions. Is that the thinking at the company as well?
Well, for us, yes, that's exactly what the thinking is. There has been improvement in the gross margins. Most of it has been put into A&P, and some of it has slowed down. Going forward, the outlook on commodity prices, I think we will see a lot of volatility. I don't think it's going to be a one-way street in terms of downward movement of commodity prices. There would be volatility. Oil already is firming up a little bit now. How the whole traction would be in terms of prices is a little bit early to say. But I think it would be a little bit more benign than what we saw last year when we saw extremely high material inflation. So let's see how it works out, but A&P spends are going to remain robust, at least in our case.
Okay, and what about the international outlook? How's the integration with Thobi Namaste going on? What are you targeting in terms of overall growth in FY13? Last year, I think it did about 600, 650 crores. Could we see a 20-30% jump there?
3% is aggressive. I think it'll be more in the region of 20 or thereabouts. The integration piece is going apace, and I think there's a lot of work to be done in building a supply chain for Africa, which is really the epicenter of our integration efforts. So that's not something which will be completed in the next couple of quarters. It'll take this year and perhaps a bit of next for it to be completed, and then the fruits of the integration will be visible, which is primarily going to be driven by a local supply chain. The international business otherwise is doing well. The Middle East and Africa businesses are doing exceedingly well on the back of rapidly softening raw material prices, because those are largely dollar-denominated regions, and the demand piece also is fairly robust there. So no major issues on our core businesses overseas, which are in the MENA region.
Are you contemplating any new products or new positioning in any of your, any or all of your products? I mean, any new juices, any new toothpaste that you might enter? Shampoos are seeing a lot of competition, so anything in terms of different placements. Your herbal products, a big category. Any repositioning to tap the youth? Actually, anything in the big brand space.
Yeah, I think we've got a huge number of initiatives which are in the pipeline. Some are pretty close to fruition, some are a little bit longer in terms of going to market. Now, how many we put to market would depend upon the whole demand situation, the margin environment. If you're under margin pressure, then we would be a little bit more circumspect in introducing new products, and the other way in case margin pressures are not there. But we do have a lot of very interesting ideas in beverages, in home and personal care, in healthcare up our sleeve, which we would like to put to market if the economic situation so allows.
So would you spend more on ads than you did in FY12?
Yes. Almost certainly. I think we already are spending more, and that trend will continue. But if you want to introduce a large number of new products, they are incredibly demanding in terms of advertising and promotional spend. So you can do it in good years, and in years where the margin pressures are high, you have to be a little bit more circumspect in introducing new products. So how many products come into market will be an outcome of that. It certainly will be more than last year, because in aggregate terms, we do expect the margin environment to be better than last year. But we still may not put all the ones which we have in the pipeline to market.
In terms of the distribution reach, Mr. Duggal, you've worked quite a bit, in terms of reaching out directly to the villages. How much will that support volume growth? Do you see upside to your, internal volume estimates for FY13 on that? What's the feedback on that so far?
The volume impact certainly will be there, but what we are really measuring more is the profit impact in terms of the rural outreach. We do expect a wider assortment of our products to be available in the rural markets. Many of them are generative of high margins, so that will be good for the bottom line. So it's an omnibus plan which does not just mean that we expand our distribution width, but we expand the quality, we improve the quality of our distribution, and that's really the main focus. And that's work in progress. We should be completed significantly by the end of second quarter, and the results are already being visible in terms of the volume.
So 10-12% in terms of volume growth is a fair assumption?
I think 10% is something which we should certainly look at, and if the monsoon is normal, then it could go up to 12. But 10 is something, we'll be very disappointed if we don't do 10, quite frankly, this year.
And will the margins be at 15-16?
The margins, yes, should be in that region. Higher level of gross margins, but then a higher level of A&P spends. Some flow through on account of operating leverage and other management of costs. So that's what the P&L should look like this year. But having said that, it's just barely 3 months into the year. So I would hesitate to give any clear outlooks. A lot will depend, like I said, on the monsoons.
Fair point. Mr. Duggal, we appreciate you taking time out for us. Thank you very much for joining us. That would be, under the circumstances, a very optimistic voice to be able to maintain that kind of growth and those kinds of margins, and more importantly, increase ad spends. I wonder if the owners of the media companies are listening to what Duggal is saying. So there is some optimism on growth in some quarters. Important to take that into cognizance. Take a break on that note. We'll get you some expert opinion on the rupee now. That's quite a move today, 1.2%, 1.3% rank out.